Welcome to FuturesOptionsETC.com's online video trading tutorials on options. You can also contact us at training@FuturesOptionsETC.com for any dedicated training needs. You can visit our website FuturesOptionsETC.com and see through all the different articles. In this set of video tutorials, we'll see how to trade a short strangle option trading strategy. As you know, short strangles option strategy is traded when you don't expect too much of price movement in the underlying. So for example, if say IBM stock is currently trading at $50 per share and you believe that this stock price will not move much and remain confined to a range of $40 to $60 in next 2 months time. So typical scenarios when you should trade this is when you don't expect any big corporate announcements, any big company reports or outcome of projects, etc., and then the stock price is expected to be relatively stable. Ideal strategies to trade in such scenarios are the short straddle or the short strangles. In this video we'll only focus on short strangles, and straddle will be covered in another set of video tutorial. So let's say we try to construct this short strangle option strategy, and the way to do is we have to short one call option which is slightly OTM, that is out of the money, and we'll have to short another put option which is again slightly OTM, that is a bit further away from the current traded price. So here IBM is trading at 50, so the call strike is selected at 60 and the put strike is selected at 40, and both these call options are costing me $2.50 each, taking the total option premium that I receive as $5. Since both are short options, basically I'm selling them, so I'm going to receive this amount of money. This short strangle option trading comes with limited profit but with unlimited loss potential, so only advanced level options trader are advised to trade this. We'll see how this calculations will work in a short while. Also, since we are shorting two call options, there is a big requirement for margin money, because any shorting in option requires margin money, and then you are going to enter two trades at the entry level, and you are going to exit two trades or get exercised with at least one of the trades, so the brokerage might cost you a lot of money. In case say your prediction comes true and you have made a profit, basically the stock price of IBM does not move much and stays in the expected range of $40 to $60, then what is your profit? Then both these options that are shorted by you expire worthless for the option buyer. He can't exercise them, so you basically get to keep all this option premium with you. So this is your profit. So basically you receive $5 as the total option premium, and 100% is your profit. But on the risk side, it gets really dangerous. In case of a loss scenario, that is your prediction is incorrect and IBM stock price makes a big move, suppose it moves to $80 on the upside, then what will happen is that the short call option will get exercised and you will have to pay the difference with respect to the strike price of $60. So the difference here would be 20 plus you have received $5 from this trade, so therefore your net loss would actually be only 15. So basically you will end up paying $20 at the exercise of this call option, but you have received $5 upfront from the sale of those two options, so your net loss is $15. In terms of percentage, it comes to 300%. In the other case, when the stock price falls to $20, the call option will expire worthless, and the put option will be exercised, so you'll have to pay $20 again for the put option exercise, but you received $5, so the net loss to you would be $15. In terms of percentage, it is again 300% loss. So this comes with limited profit, where the profit is limited to the total option premium of $5 you can get to keep, but loss potential is huge. The further this underlying stock price will move, the more loss you are going to make. So this is said to be a dangerous strategy to trade. It is advised only with strict stop losses on both option premium as well as the stock price movement, and only advanced level option traders should trade this. Now let's get into the option payoff function for this. What we have here is a short call of $60 strike price, which is represented like this. And we also have a short put of $40 strike price, which would look like this. Now we have to add these two together to get the net payoff function for the short strangle. So this is how it will look. Between 0 and 35, this brown graph is 0 and the green graph is slanting upwards. So if I have to add this, then slant plus 0 will give me the slant. So this is how I'm going to get the net payoff function for this between 0 and 40. Then between 40 and 60, both these graphs are 0. So 0 plus 0 will give me the same 0. And above 60, this green graph is 0 and the brown graph is slanting downwards. So slant downwards plus 0 will give me same slant downwards. So this is how I'm arriving at the net payoff function for this short strangle option trading. However, we have received a total of $5 as option premium from the sale of these two call and put option. So let's account for them as well. When we are selling something, we are receiving the money. That's a net inflow. So that's why it is taken as positive. So when we are receiving something, we are going to shift this graph upwards in the positive direction. So whatever is at 40 will shift to 35. So let's take this blue color and see how this particular thing will look. Whatever is at 40 will move to 35, whatever is at 0 will move to plus 5, and so on. So this is how the net payoff function for a short strangle option trade would look like. Now if you look closely, what I have here is two very simple break-even points. One is this and other one is this at 65. So one is at 35, other one is at 65. By break-even point, it means the profit and the loss here and here is 0, and on either side of it there is a profit area and loss area. So if we look at this particular region between 0 and 35, the loss keeps on increasing as the stock price keeps on going downwards. So here at 25 the loss is minus 10, at 20 the loss is minus 15, at 10 the loss is minus 25, and if the company goes to bankrupt, then I have a $35 loss. Similarly, above 65 my loss will start increasing further. At 75 I'll suffer a $10 loss, at 90 I'm going to suffer a $25 loss, at 100 I'm going to suffer a $35 loss, and it will continue further. So the profit area is confined to this region between 35 and 65. Between 40 and 60, as you can see that the profit is capped to a fixed amount of $5. So if the underlying price ends up between 40 and 60, I'm going to keep the option premium of $5, and that is my maximum profit. Between 35 and 40, my profit is a bit variable. It increases linearly, and same thing goes here between 60 and 65. The profit is actually a bit linear, but it goes down as the underlying stock price moves from 60 to 65. So this short strangle option trade, what I'm trading on is a limited profit potential which is confined to this region, but I'm exposing myself to a big loss either in this side or on this side, which can hurt me very badly. So options traders should trade this short strangle option trade with care.